All right, all right, all right. Good morning, good morning. How's everybody doing? We got a nice crowd here already starting first thing in the morning. It's good to see you guys all here. Glad to have everybody here. We got a big day today. We haven't been able to cover all of the stuff we've got, I got planned for you in every class. And my classes sometimes went 2 hours and we still only covered half the things we had planned to cover. So a lot to talk about. We got a lot to talk about. I want to tell you something really fun and new, though. This is something I want you guys to all see. This is a new book that we're publishing at Pitt News Press. I'm so excited about this. You can't buy it yet, but I'm getting a pre-release here. I'm just getting too excited. I didn't really mean to tell everybody because it's not the release yet, but I was just so excited for my class for you guys to see this. It's called The Orion Protocol. It's a novel, but it's by Grant Thorne. How many of you know Grant Thorne? He's the Washington correspondent for Pitt News Magazine, right? And he's been with us now for about 6 months, and he's written about 6 or 8 articles. Some of them have been podcasts, and he wrote a book about all of his research behind those articles, and he turned it into a novel. Novel meaning, it's not true. It's a novel, but it's true. It's based on all the facts that he found, right, for the articles that are published in Pitt News Magazine, and then he wrote a story about how he come up with all the stuff. It's a really cool, fun read. It's going to knock your socks off. It's not very big. It's 120 pages, but you'll sit down, you'll read that in one day. It's just such a fun read. And I'm really excited about getting that out to everybody. We're going to have a lot of fun. We got a lot. And then, of course, Claire is like, Grant can't upstage me. So now she's in the middle of writing her book, too. So she'll have a book coming out, too. So we got things happening here at Pitt News Press, not just the magazine. Pitt News Magazine is kind of the cherry on top, but we got other things that we like to do. So we're having fun here and exploring different ways to provide great, wonderful, fun things for you guys to enjoy. So that's one thing. But let's get down to business. The first thing we need to do here is we need to swing on over and we need to check out the news. All right, that's the first thing I want to do. So we're going to come in here, economic calendar. So here's the economic calendar for today. And today is Thursday, October 16th. And we got a lot of things on the docket here, but most of us just the Fed is speaking. So Fed. No big decisions are being made, just lots of Fed speak. And so the markets, whenever the Fed does this, the markets are really crazy, right? Very volatile. That was in Pitt News Magazine. If you remember, the Pitt News Magazine talked about the October issue and how the volatility of October because of the Fed and what they do in October. So October is a very volatile month. Oh my goodness, hold on a second. I'm already losing my voice. Let me get a drink of water. All right, get everything turned back on here. All right, so we are rocking and rolling. So this is all the crazy stuff that's going on in the month of October. All right, so all right, so let's come down here. What's happening? The biggest news next time is Friday. Fed Musalam speaks. So you got more Fed speak. Housing starts comes in on Friday. We don't really have anything today. Just a bunch of Fed speak. Crude oil. That's all that we got today. Nothing really special today. But tomorrow we got housing starts. So 132, 133, 130.7. It's forecast to be up. More housing starts. Building permits are down 2%. Export prices, housing starts, import prices. So we got a little bit happening tomorrow. Tomorrow will probably be a little bit of a bumpy day. Well, it's all in the afternoon, 2 o'clock after the market closes. So the bump will probably come on Monday because that's Friday news will come out and then they'll trade it on Monday. All right. So it'll have time to cool off a little bit too. So we'll see. But there's not a whole lot of news today, just a bunch of Fed speak. So just expect a lot of volatility today. All right. So that might be good for you guys who want to do a little day trading. You might get a little volatility today as the market, as these guys speak. All right. So you can get a little bit of a run in the markets. Be careful. They're not going to be trends. They're just going to be spiky dikey doos. But you might get some short trends that you could pick up on your day trading. So we'll have to keep an eye on that. All right, let's come over here. I've got in our little, I got so much stuff here on the screen. I got to show you. I got so many things. That always pops up over there. How come? I wish it'd pop up over here. I'm by myself. I don't have somebody helping me like those fancy stations. All right. Those fancy YouTubers with somebody behind the scenes. All right. U.S. government secretly, did I spell secretly right? Secretly buying stocks. Did you know the U.S. government's been secretly buying stocks? Now, we did an article. Grant Thorne, right? Grant Thorne wrote an article. Actually, it was a podcast. I don't think it got published in the magazine, but he did a podcast with Claire on Intel, right? Intel, the government buying 10% of Intel, and that's in here. He writes a whole section on that, and so that's a fun thing that he's got in there. But the government's been secretly behind the scenes and not been a big announcement. Nobody's really been talking about it, but the government's been buying up stocks. Did you know that? They've been buying companies. It's the same thing that we always complain about China, right? We complain that China is secretly, well, China doesn't do it secretly. China goes in and picks winners and losers, and they pick companies and they become government-owned companies, right? And we're like, oh, that's not good. Don't do that. But now here we are doing it. 1, 2, 3, 4, 5 companies have been purchased by the government. Now, some of you might have heard about Intel. All right. Intel got picked up by the government, and that one was kind of a big deal. It made the news. But the rest of them, have you heard any others? Have you heard any others at all? Let's go over to our trading platform and create a portfolio for government buys. I might have already done it. No, I probably did it in another book. Okay. So we'll show you how I do. We'll hit new, come in here, and we'll just come in and we'll say government purchases. I had somebody complaining about my software yesterday and saying, why are you got all these white colors? Why don't you use the black, newfangled, futuristic colors like all these other companies? And Track and Trade has that ability. If you want to have the futuristic, all the neat stuff, black colors, green text, all that neat stuff that's futuristic looking stuff, you can come in here and turn that on. It's called color themes. And you can go with the chart color themes that you want. You can go with dark color themes, light color themes. You got all kinds of color controls. I use the old-fashioned, as he called it, the old-fashioned white colors because it's easier for you to see on YouTube. Now, I was one of the biggest proponents of getting the black colors in there, and I love them. I think that the black colors are really nice. They're easier on the eyes. It's the software looks great when it's black. When you install it the first time, it comes up and asks you, do you want, the newfangled black colors, or do you want the old-fashioned white colors? And I started when we got that new feature in the software where it was all newfangled and black and slick and all that kind of stuff. I turned that on, and then everybody complained they couldn't see the screen. So here on YouTube, I had to turn it off. So I have the old white colors, just the standard white colors, because you guys can see it on the screen easier. But when I'm by myself and I'm just trading, I like to turn on the black colors because it's nice. It's fun to see too. But you guys, when you install your software, you can pick that newfangled modern. I remember back, do you guys remember back in the Radio Shack days? Back when we had Radio Shack, and we would all go down to the Radio Shack and we buy our stereo systems that we'd put in our house, right? It used to be when we were young, everything came out was black. The stereo systems were black, car radios were black, everything was black. And everybody was like, oh, that's the neatest thing in the world, black. And then we went through a stage where black was out. Nothing could be black. Everything had to be silver and white and all that kind of stuff. And so we went through that same stage with the software. We had black versions. That was the very first version that came out, was a black version. And it was really cool. It had green text and all the stuff. It was really neat. And then, oh, that wasn't cool anymore. We had to get rid of the black and everything had to come in, or we had different colors, just kind of this white gray stuff. Microsoft was kind of the ones that did that in their software environment. So everything went to this color. And then now recently it's all gone back to black again. So all the software, if it's not black, it's not modern. It's old fashioned. So the software does black if you want it to be, if that's a thing for you. I'm more interested in the features and the functionality of the software than the color and the look. But the color and the look is really cool in the black model if you want it. All right, so that's available to you just so you can go look. And when you install the software for the first time, it asks you, and you can pick black, and it's really cool looking. But this is not, it's not old-fashioned. It's just the colors that show up on YouTube easier for you guys to see. So anyway, get that off my chest. All right, so here we go. We got Intel, INTC. Now this got purchased by the government right about in here. This is why it took off like a rocket ship, okay? Because Trump bought 10% of Intel. He used the money that Biden had set aside to just give to him for free. Just here, guys, have some money. And he was trying to help him grow, right? I mean, he's doing the right thing, trying to help him. Just throwing money at him is what he was really doing, which is typical for the federal government. That's what the federal government does. They just throw money at industries they want to grow. But Trump took that money that had been set aside to go to the chip makers, and he bought the stock instead. And it's a little bit different. I'm not, I like Trump, but he does some stuff that I'm just shake my head at, and I'm like, and that's one of the things I'm like, why are we buying companies? That's what we always get mad at the Chinese for doing, right? Oh, you want to live in a Chinese communist state? Go over there where they buy companies and they own the businesses. Now we're doing it. Is that the right thing to do? I know we're in a war. I mean, basically we're in a war with China, right? Trade war. And they control everything. I mean, the past administrations have given China everything with that big sucking sound that Ross Perot talked about. The minute they signed all those deals, that big sucking sound just went to China and Mexico, and it sucked all the growth out of this country. We can't do anything on our own now. We can't do anything without China. We can't even run our military without China, and China's the biggest, adversary. So you can't build a Tesla car without China because you can't get all the rare earth minerals and all that kind of stuff. And so that's what Trump's been behind the scenes doing. Another one of the companies that he just bought a 15% stake in is called MP Materials. This one here. All right. So now the United States, you own, because you are the government, right? I mean, your tax dollars just bought MP Materials. Did you know that? You now own 15% of MP Materials. And did you know that you, as a American citizen, for those of you who are American citizens, we got some foreigners in here, and that's cool. It's fun. We love to have you guys too, but this is the U.S. markets. All right. So MP, we also have LAC. What is LAC? LAC is a stake in Lithium America. Why do you think we did that? And look what the stock did. Did you know we bought Lithium America? That's when we bought it right there. That's when the federal government bought Lithium America. Now has Lithium America, we have 10%. All right, these are my notes over here. What's the next one the government bought? TMC. No, not the TV show. TMC, the metals company. Did you know the federal government bought TMC? 10%. 10% stake in TMC. Did you know that? Now, they also bought what they call a golden share in U.S. Steel. What is U.S. Steel? I'm not sure what the ticker symbol is for U.S. Steel. Come on. Search. It's not coming up. Let's ask. Do you guys, anybody quicker than me? We'll ask Perplexity. What is the stock ticker for U.S. Steel? U.S. Steel. Well, they give me what? Oh, here it is. STLD. STLD. All right. STLD. Steel Dynamics. That's what they pulled up. Steel Dynamics. That's not U.S. Steel. Is U.S. Steel? The stock ticker for U.S. Steel, United States Steel Company, was X. However, following its acquisition by Nippon Steel, right, because they sold it to Japan, U.S. Steel was delisted, and the ticker symbol X is no longer active. Traders associated with the company, and that's why it's not a symbol. That's why it's just a golden share. All right, so they bought a golden share. What does that mean then? Let's ask. What does it mean when they say they bought a golden share? What does it mean when they say the U.S. government bought a golden share of U.S. Steel? That means it went to Japan. It's going to be listed on the Japan. Is it going to be listed on the Japanese? When it is said that the U.S. government bought a golden share of U.S. Steel, it means the government acquired a unique type of ownership stake that grants it significant veto power and control over certain key decisions at the company. Even though the stake is typically nominal and does not involve substantial equity or economic benefits like dividends, this arrangement emerged as part of the merger between U.S. Steel and Nippon Steel, as was intended to address national security and economic concerns. Now, if you remember, U.S. Steel tried to sell out to Nippon Steel. The Japanese tried to buy U.S. Steel, and Trump was like, no way, I'm not letting that happen. But U.S. Steel wanted to sell out to him, and Trump can't. I mean, he could stop it, but then he decided, okay, let's do it this way, but we're going to have a golden share, which gives them the ability to veto things. And when he was talking about it, if you remember listening to him talk about it, he said it was if Nippon decided they were going to move everything out of the United States, all the steel companies, he could veto that. The president of the United States could say, no, we have a golden share and we can veto things like that. You can't do things with our steel company. We sold it to you, but you don't get to really own it in the sense that you can't take it and leave with it. You can't take it over to Japan. So the golden share lets the government, specifically the president and their designees, block major decisions such as a change of headquarters, a reduction in U.S. investments, a sale of the company, or changes in raw material sourcing. Unlike traditional shares, the golden share does not mean the government is involved in daily management or profits from the company. The move is rare in U.S. corporate history. That's what we're talking about. This is not capitalism anymore. And it signals an extraordinary level of federal control intended to safeguard American strategic interests while allowing the foreign takeover to proceed. So it's still a foreign takeover of our steel industry, but we have this golden share which allows us to protect our strategic interests. What do you guys think of that? Do you think we're riding a scary line there? Are we being forced into it? We can't compete against China because China has the government backing all of their corporations, and so our corporations are struggling to compete. That's what the whole argument is. Kirk says U.S. Steel used to be X. Yeah, they said it's delisted. So let's see what even happens. Probably not even going to come up. So what do you guys think of that? What do you think of the government buying up corporations and competing? They're saying they have to do it because China is getting out ahead of the U.S. in so many ways. And our companies can't compete against China. So they need help from the government. So the government's starting to buy up. And some of these companies are like lithium, right? So that we can have our own lithium sources. I was watching the news last night, and there was another one. And I sent the note to me by email, and I can't find it right here. So I'm going to have to talk to you about it on next time we get together. But there's another one that they just did too. And they're going to start building more. They just started approving more mining in the U.S. on a fast track for rare earth metals, including gold. So they're doing that. They're paying it, putting money into these companies because they've got to help these companies get off the ground because China controls all the rare earth minerals. Now, when you listen to the Trump administration talk, they're like, they're not really rare earth. They're everywhere, all over the earth, but they're being mined mostly in China. When China does the mining, anytime what I think it was Bessett was saying, anytime the U.S. would start up a mine to do rare earths, the Chinese would come in and drop their prices so low it'd put the mines out of business. So they were doing unfair practices because they could lower their prices because they were backed by the Chinese government, right? So it wasn't fair competition. So they were putting all the mines all around the world, not just the U.S., but they're putting the mines all out of anywhere else in the world out of business, or they're coming in and buying them, putting them out of business, and then coming in and buying them. And so China's got rare earth mineral mines all over the world because that's what they would do. They would drop their prices. The mines wouldn't be able to operate, make money. And so then they would come in, swoop in and buy them. And now China's got all the rare earth minerals. So the Trump administration is saying, well, we've got to compete on a level field. We got to help our mining companies here in the U.S. get off the ground. And so that's what you're seeing here. So you're seeing they're buying lithium, they're buying the MP materials, they're buying, well, that's Steel Dynamics. That was the one that ST. Yeah, we didn't have that. It's Steel Dynamics. What was the symbol? STD? That would be very I was gonna see that wasn't what that was. Sorry. That would not be a very good stock symbol. All right. So who wants to have a stock symbol? STD. I don't know, maybe somebody who creates that would be a funny stock symbol. All right, LAC, Lithium America MP. Let's go look at them. Do you want to buy any of these? Probably not bad to buy into them. I mean, they're backed by the federal government at this point. I mean, the chances of them going out of business is pretty low. I mean, federal government bought them. So it's not like you're going to buy something that's going to go out of business anytime soon, I would say. The question is, are there enough people who want to jump on board and keep pushing these things higher? So you got Intel coming in here, and we got it's hard to, but there's our first entry right there. So there's our drive. If we could get it to pull back, break those blue lights, which it will, it might take off again and go up here, and the blue lights would, have to intercept up even higher, but you never know. You can put your progressive trend line in there at this point. So that's kind of what we're looking at. Oh, let's see. So we got kind of a little trend line. It'd be nice to see a little pullback on Intel. Let some of these guys take some profits and see if we can't get a little pullback in here, just enough to, it came close to that 38.2. It's got to break the blue lights. So when it breaks the blue lights, that's when we can be buyers of Intel, get some money in there. I would do it, of course, with some options, buy some options. Trilogy Metals, TMQ. Is that another one? Did they just buy that one too? TMQ. Mutton Jeff says TMQ is another one. Trilogy Metal. Looks like it's in play. So they're going there. My notes were the first 5, and the 4 were the symbols. And now you've got another one in there. Let's see. Let's ask. I'd rather ask Grok. Grok's a lot smarter than Perplexity. Let's go ask Grok. Okay, Grok. Come on, Grok. All right. So, how many publicly traded? I mean, we just want to know companies. How many companies has the U.S. government invested in buying stock? I wonder if there's any more. TMC. I've got my information says TMC's in play. LAC and TMQ. LAC, I got that one. Trilogy Metals. I've got that one as one that they bought. TMQ. How come Grok he's taking too long to think? I've got him on thinker. That's a problem with Grok. He wants to think about it forever. Come on, Grok. All right. So you're saying TMQ. What was the other one you said? LAC, TMQ, LAC. We got those. TMC. We got those. All right. We got all those. Trilogy Metals. How come Grok's taking so long? All right. We'll go back over and ask. Let me take that. We'll ask the same thing over here to Perplexity. How many companies the U.S. government invested in, buying stocks, etc.? As of October 25th, the U.S. government has direct investments or ownership stakes in at least 5 major publicly traded companies, mostly as part of the new industrial policy moves with a focus on national security and domestic supply chains. These holdings include 10% stake in Intel, 15% stake in MP Materials. Okay, we got those two. 10% stake in Lithium America, 10% in Lithium America, we got that one. And 10% stake in Trilogy Metals. We got that one. So TMC is the metals company. Stake in MP Materials. What are the stock symbols? Give me the stock symbols, tickers. I don't want to see them like that. I want to just list them out. Okay, here we go. So INTC, MP, LAC, and TMQ. So TMC is not one. TMC is definitely the metals company. So TMC, oh, I got that as a 10% stake. It's TMQ. It's what you're saying it is. It's TMQ, not TMC. So I don't know why my notes over here say TMC. Where I got my information from might have been a spelling error. But it's definitely, they definitely said TMC. So TMQ. So TMC is questionable. I'm not, well, let's ask. What about TMC? I heard TMC was in play. The metals company ticker has recently been the subject of widespread speculation about possible U.S. government investment or equity backing. Through no official announcement has confirmed such a stake. Reports suggest TMC could become a target for U.S. strategic funding due to its role in developing deep-sea mining for critical minerals like nickel, cobalt, and manganese, materials vital for defense and electric vehicle supply chains. The speculation follows its recent regulatory progress in the U.S. deep-sea hard minerals resource and its subsidiary receiving full compliance confirmation for exploratory applications from NOAA. So not yet, apparently. So my notes, or my source was a little ahead of the game on that one. So we'll leave it in there because it's speculating that they're going to buy that one, which is probably why it shot up like this. It's under speculation right now. They haven't actually bought. So, but they probably will. Grok said he couldn't find any information on it. So now I'm not so pleased with Grok today. All right. So those are our stocks that were in play. So Intel, we're just waiting for a little opportunity to put some money in. I'd like to see a little pullback. We might not get it. That might be all we get. That little wedge pattern right there. We'll have to wait and see. If you want to wait on it, what would we do? If we wanted to buy into this one, we could just buy some shares. But if we want to capitalize on the growth, we come down here and let's look at. There's several ways. You could just say, well, I want to go out, 64 days or something, or based on the Fibonacci projections, we're going to go out 2 months, 3 months. So you go out 90 days. So we go 90 days, see what it's costs. That'd be $500 to do a 90-day option on there. And you can just buy the call, nothing wrong with that. A lot of them being sold $15. That'd be an easy purchase right there. And I'd probably buy the one that's just one tick in the money. I'd probably buy the next one down. I'd buy this one, $550. Buy that one right there. That would be an easy purchase right now. It's only 92 days out. It's $500. It's not a big deal. If the market pulls back a little bit, we could add into it. 90 days gives you enough to anticipate the market rising up out of this pattern here. All right. So we go ahead and we'll just we're going to buy that, they're asking 560. So our spread on it would be $5. Is that right? Yeah, that's what it says. All right. So place your order, and we got one of those. Longer term, we could come in here and we say, well, I want to go do a leap. A leap, I would like to see it pull back a little bit. I'd like to see it down here in the Fibonacci sweet spot to buy the leap. We may not get the leap. So we would wait for it to come down here to buy the 300. Maybe we'd go out. That's 2026, 5. I'd like to go out a whole year. Here's 2026. That would be the last one of the year. Let's see what the volume, plenty of volume. Look at this. Lots of people are buying them. So that's just be $1,000. Look at that. That's it. 90 days, 92 days, you're paying $500 for an entire year. You can get for $1,000. So, I'd really like to see a little bit of a pullback to get into this, but we could put one of these in here and start doing a poor man's covered call, right? So we buy, you want to put $3,000 or $4,000 into this thing, $5,000. You could do 5 covered calls every month against it, and just sell covered calls against it, and just live off that. I mean, what would you be able to do? Let's see. Let's do one. Let's say if we had that and we wanted to do a covered call against it, well, you could come up here with 5 of them. If you did 5 of them, just to get $500, 5 times 5 is 25, $2,500. You could just sell this one. How far out is that one? Well, look at that. It's way out there. Well, that's 428 days. You're not going to sell that. Sorry. That's a mistake. We would not do that one. Let's just get rid of that one. Here, clear that. So we'd have to come down here and we'd do the shorter term fund. We'd do 36 days. So to get $500 on a 36 day would have to be this one here. And that would be a little, we need a pullback. That'd be a little close. Yeah, we need the pullback. If we don't get the pullback, we're going to have to do it right at the money. We could do one right now, not do all 5 of them. We got the 92 days here. If you wanted to, you could sell a call against that. What could we do there? If we got 92 days, we could sell the 30 days. We'd sell this one. That's going to give you $200. It's going to give you where do we expect? See, that's the thing. You have to do the Fibonacci projection. If the market continues to go like it is, and if that was the max pullback that we got in there, we don't know where it's going to come back to. See, that's the problem. That thing would be at one. It could be up here. That's 100%. It could be right there by close of business in 39 days. So you're close to get that's only $97 against your, it's $97 against your $560 investment. So you could cap it like that. You could get an extra $124. You get $139, $150. I think we want to kind of stay up in that 90% region up in there. You could come all the way down to 50, but then you're capping your profits. You get more, $200. But if we think this market might be explosive, we wouldn't want to really cap it too far. So we will go up in there. So we get 100. We add an extra $100 to our $600 is $560, and then add an extra $97. That's good money, right? So you could sell that. So we come in here, and we're going to sell it. We're going to go down to 81. What are we going to have to pay? Oh, we might not want to do that. Look, we're going to pay $33. That's not good. If you do it in the real market, this is the demo, of course. If we do it in the real market, we could probably get better than $33. We could probably get it at 97. So if we did 97, if we could get it at 97, we could do it. That would be $17 on the spread. And that would be okay. You could do that. You could sell your covered call against that long 90 days. But it'd be fun to do with this market, because the government's in there, it'd be fun to do poor man's covered call. Buy some leaps and just sell calls against it all year long and just use it for income. That's what we do with the yield max funds. I mean, it's basically the same concept. We're just doing poor man's covered calls in yield max. We give yield max the money, and then they do poor man covered calls with them. And then we just live off the income that we make from selling the premium on the options. That's how it works. So that's a strategy that we could do. All right. So For now, we're going to sit on this for a second. I want to watch it and see if we can't get just a little bit more pullback down in here. Might not get it. Everybody's too excited, but it'd be fun to see a little bit pullback down in here so that we could pick up a covered call, a long-term leap. All right, let's go look at lithium. I don't know what options are on lithium. Let's go see. Let's go out to 92 days. Oh, look at the volume on this thing. It's picked up like crazy. So yeah, we could definitely do some options on this one too. So we got a red bar today. That's good. Let's see if we can't get it to break down and break that blue light. That already broke it once. There's a blue light right there. I would like to see it come back a little bit farther. All these profit takers in here. That's right close to 38.2 right now. That would be our first buy zone. So Fibonacci sweet spot right in here. So I would like to see it down in here, get the first green candle, make a new high, and then that's, of course, you want to wait for that little triangle formation, wait for it to give the greens and then a couple reds, and that's where you want to buy. You want to buy on a red when you're doing options for a long call. If you want to go long, you want to buy on a red. Why? Because the implied volatility goes down. Look what the implied volatility is right now. Look at that, 129. Holy smokes, that thing's on fire. Implied volatility of 129. You want to be selling premium here because that would collapse. Wow. Let's see what we could do here. Let's come in and, of course, you want to do this on a green bar. So this strategy is a green bar strategy, but it's red today. So, but we'll put it in here. We're going to come in here to the options. We're going to come in. We're going to go out. Let's go out that 36 days. Plenty of volume, plenty of open interest. Oh, the spreads are tight. Implied volatility is out of control, but the premiums are small. It's because the market is only an $8 share. The spreads are going to kill us. That's no fun. All right, so let's take a look. If we sell this one and we buy this one, oh, that's out there quite a ways. If we do a Fibonacci projection, how long do you think, if it comes back down, let's say it just comes to the 50% level, maybe out in here, that would put us right here. If the market took off and ran the same as it did with the little pullback, gave us an ABC back up to there, I don't know. The second leg might not be as strong. The second leg might be stronger. You never know. Depends on how many people get in there and find out about the government buying LAC. They've kept it pretty quiet. So you'd receive $32. You receive $12. It's a 2% return. See, it's not that much. You bring this down one more, you're going to get a 2.8% return. $250 to make $7. Your spread is $8. It's not worth it. You're going to have to bring it in closer. If we bring it in closer, one more click on both of them, that'd bring it up to 15. That's a 6% return. We're just playing with such tiny little dollars. It's not. You're going to have to buy, like, if you did 100 of them, that would be the 100's too many. That'd be $25,000. Let's do 10. So if you did 10 of them, that'd be 2,500, 6% return, or you receive $150. It's a why bother? 6% return is not bad. I mean, it's pretty good money. I mean, it's a 74% chance you're going to make your money. Yeah, you're going to make your money. If the market rallies, you'll make the money on the long. Well, we don't have a long call here, do we? This is just straight up selling premium. It's $150. I don't know. It's 6% return. If I'm not up over 10% return, I don't really want to do it. I like things closer to even 15, 20% return. 6% is not good enough. And that's because the market's red right now. You bring it in closer. But if we bring it in closer, then you got too easy of a chance the market taking off. You get to receive $320, a 12% return. But see, now your chances of it paying off are only 60. You're basically a 50-50 chance in here of making money. So I don't think we got an opportunity here selling premium. We've certainly got an opportunity here to buy some premium. We could come in here and definitely buy some of this. And we'd probably want to go out longer, at least 90, maybe 127 days. Let's see what the volume is. Plenty of volume. So you can put in $250 to buy one. So you could buy a long position, and today would be a good day to do it. You buy on a red bar because the implied volatility is going to be lower. It's $135 on the 135 on the implied volatility. We always consider anything below 50 is good volatility. Anything above that is high volatility. And when it goes above 100, it's like out of control volatility. This is 131%. Now we could look at the historical volatility on this thing, HVOL, and you can see it's usually clear back here. It's usually really low, below 50, and now it's gone all the way up to 200. It's unreal. Now the market's flushing, so look, the implied volatility is coming back down. So if you want to buy, that's when you want to buy, when the volatility is coming down. You want to buy for a long position on red bars. All right. So if you just want to get your feet wet in this thing, it'd be fun. You could just buy one, and that's $250. You put up $250, that's the max amount of money you can lose, and you got unlimited profit potential if this thing keeps rocking and rolling. So we could come in here and buy 10 of these. That would be 2,500. Let's put in 5 of them. Actually, yeah, we'll do 5 right now, and if it falls further down into the 61.8 and into the Fibonacci sweet spot, we could buy 5 more. Do a little dollar cost averaging with our options, right? In anticipation that this thing's going to take off and go to the moon. We don't know. That's why you buy options. That's why it's a speculation, right? So we're going to come in here and we're going to buy 5 of these. You could buy 3 of them if you felt a little bit like it's still going to come down another day or two. Just get in here with the first one just in case it turns and takes off from here. You don't know. Nobody knows. So you put a little in now, you put a little bit in later, you put a little bit in on Monday, put a little bit in on Tuesday. Dollar cost average yourself in right down in here until it gets down in here, and then anticipate the rally. So don't go all in on the very first entry. And we got a red bar, so we'll add a couple. We'll put in 3 of them, $750. We're going to buy it, so we got to go to the ask at $250. Oh, right there, $250, $30. So place your order, and we got 3 of those things. The spread's a little wide on it, but in the real money, you could probably bid that down a little bit. All right, so make sure you bid it down a little bit. All right, so there's 3. There's that one. Let's come in here and look at the materials. Now this one, MP. Oh, this one's in. They did buy 15%. It was the TMC that we were questioning, right? So TMQ was in play. So let's go look at MP. This one here. Oh, that one's a pretty market. $88 a share. MP Materials. Let's go take. We got to also do a little bit more. I skipped some of this on the others. LAC. We should probably go do that. Let's go look at MP though. Over here, we're going to come in here. And see the colors on this one? Nice and pretty black. Well, you can do that with track and trade. You can make track and trade look just like that if you like that color. It's harder to see, right? You guys are complaining. Don't use the black, Lan. I can't see. But then why is yours outdated? Why is you got old-fashioned software? Why isn't it black and pretty? Because you can't see it. I haven't had anybody complain about this one, though. I don't know. Anyway, MP material. So here it is. Let's come in. Here's what we want to look down here. Let's look at what they're doing. Income. They're losing money. Oh, sales right here. They're losing money. So sales have gone way down. Dun, dun, dun. That's because of China. August 1st, Jeffries upgraded them from a hold to a buy, target price of 80. They're currently at 87. That was in August 1st. October, BMO resumed. What did they do before? BMO initiated. Price target was $16 in July. Back in April, March, these guys downgraded. So, but the government's bought this thing now. They own some. So they're going to be able to compete against China. And I think that's, Trump's also putting some pretty serious tariffs on China too, on some of these rare earth minerals and stuff, because he wants to be able to prop up and help and support the U.S. markets, because we don't want to rely on. The thing is that our F-16s and F-32s and F-99s and our F-47s, they're all relying on all this stuff from China. We can't build them without China. We can't build nuclear bombs without China. What do you think of that? We can't do anything without China. So that's what he's trying to do. So he's trying to help out these companies that do this stuff, so that we don't need to rely on China. So, but their sales in billions going way down. Why were they really high? And then suddenly, well, probably because China was taking all their business. That was the whole problem. They even bought some shares back, try and prop up their stock. So they're a struggling company, that's for sure. They're not doing very well. All right. So the government stepped in to prop them up, to help them. And that's probably why they, that's what took off right here. So the only thing is strictly fundamentals on this thing. Just because the government propped them up, that's why you'd want to buy into it. And so we need to have them pull back a little bit. The guys who got in there early need to take some profits so that the investors can come in and take some longer positions. Right now, this is the short-term plays. So what could we do here? Now, this is going to be a little easier because the stock is right close to, so we like to do options on stocks that are right around $100 because that makes them worth doing. It's not a why bother, right? The commissions, the fees, the spread, and all that stuff doesn't eat you alive. When you got something that's worth $88, you can do better with options because you got more money in there. There's more money. It's worth it. It's worth doing. All right. So we come out here. Let's just first look at the 92-day one. That's $1,600. So if we just bought that one at the money, you'd be into it $1,600 for a long position. Now it's got a little bit of a pullback right now. See the higher highs, this is pulling back just a little bit. So I would like to see just a tiny bit more pullback. I'd like to see these guys who are doing the short-term trading take their profits a little bit more in here. I'd like to see it pull back. It's hitting 38.2 right now. I'd like to see it right down in here. That's where we would really be able to load up. Will it go pull back to there? I don't know. I'd like to see it down in there. That's all I'm saying. I'd like to see it down in there. If you want to buy one right now in anticipation of a continuation of the big uptrend, that's 92 days. Let's go look at a 300. There's not a 300-day. There's 456. First in January. Let's go see what they're doing out there. See, look at that. These babies are in play. Look at that. They're buying these things up. So, but oh my goodness, look at the spread though. $270. The premium is 3,800. It's a 0.07% spread. So that's actually not bad, believe it or not. 270 against a 3,800 spread. And you could get that down. I'm sure you could get that down, bid for it. But look at the volume, open interest. The volume's not over 100, but it's there. There's volume. 23 of them have traded today, which, but look at the open interest, thousands. So that's good. I think you could get the bid down. I don't think you'd have to pay the full 270. That's in the money though. It's 260.9. That's for 456 days. You sell one of the, not sell. I don't want to sell it. I don't want to sell it. Cancel that. Delete multi-leg. Okay, so we're going to buy one of these. I don't want to buy it there. I want to buy it there. 3,000. The spread on it's $175, but I really think that's at the midpoint. That's probably what you'd have to pay. It says down here 350. See that? So it says the spread is 350. But the midpoint is 175. I think you could actually get 175. So that's not bad. So you're going to pay 3,000. So that would be and then you sell calls against it. And we're going to come in here. So if we put that in there, let's just go ahead and, I want to see it pull back a little bit more just because I'm going to buy it right now. But just because I'm buying, look, we're going to have to go all the way up to the ask of 35 to get it to fill in the demo account. So we're going to have to pay that $300 in here, but in your real money account you won't. We got to go all the way up to 35. Come on, buddy, go faster. Type it in, man. All right, so we're up to 35. So we're going to place our order on that. Make sure you bid for it because you don't want to pay that big wide spread. Can't do that. They don't play that game of the demo. So you just have to pay the bid and the ask. So we're in here now at 350 on the spread, but we bought this one. Now what would we do to and I really don't want to buy that one. I'm just telling you, we're just doing it for demonstration right now. I want to buy it if it pulls back farther. I'd like to see buying down in here in the 61.8% region. So we're going to watch that pattern. All right. But then we'd come in here and we would go out and we'd do 36 days and we'd start selling calls against it. And go out here and sell a call. Oh my gosh, look at that. Holy cow. You do your Fibonacci projection, you're way underneath that thing. Let's even do a longer one. Oh, yeah, let's do it from here to here. Let's say it comes back to here to 50%. Let's even do it from right where we're at. Okay. That's at the 90% level. That's good. We make $470 per on each one. The implied volatility is really high. So that's why it's not good to buy, but it's good to sell. And look at that. You're going to make $470 on that thing. And if you did 2 or 3 of them, if you got 3,500, let's say you do 3 of them, you could do 3 of those. That'd be $1,500 a month in income right there. So you could sell that baby, pick up $470 for a single just on this one. See, that's why we love markets that are up around $100 because it makes the selling of the options premium worth it. Randy's making a comment here on dividends. They've changed. They send out a notice that every single thing that they're doing is now weekly. So Randy, just so you know, all YieldMax has gone to weekly dividends. All their funds have gone weekly dividends. Everything's weekly now. They pay everything out on weekly. All right, so they're rolling it out. They're rolling it out. They're going to do everything's going to be weekly from now on. So that's kind of a new thing. They just did that. They just made that announcement last week, I think, or maybe a couple weeks ago. All right, so that is a good deal right there. You can come in here. Of course, you're going to bid for it. You can try to get a little bit better price. The spread's $20 at the midpoint, but you're going to sell at $450. So you're going to have to go down here in the demo all the way down to $450. That's $40. You're going to place that order, and there you go. There's $470 you just received. So you go spend it. But this you bought this one here. So your investment is $3,500 and your dividend is $450. That's exactly what YieldMax is doing. All right. The reason you give your money to YieldMax is so that they'll do this for you. So you don't have to do it. But if you want to do it yourself, this is what we're doing in YieldMax. You give your money to YieldMax. Randy gave his money to PLTY, which means that put his money in PLTY, which means that YieldMax is the company that runs that PLTY fund. All they're doing is they're going to take Randy's money and they're going to go over and they're going to do this strategy with it. Not exactly, because we just did a long call. They're going to actually do a synthetic long, which means they would sell the option here too, so they don't even have that much outlay. It's compounds it one more time. So, but this is all they're doing. And then they take this money right here, and when that comes due, they give it to you, and that's what you call your dividend. It's not really a dividend. It's the premium they're collecting from selling options against their long calls. Now, if the market goes down, they're going to lose money, but they're still going to get this premium here, and then they're still going to give it to you. So that's why we end up, and that's why we end up in our, let me come over here real quick and go into our dividend calculator portfolio. Not that one, this one, not that one. Oh, where did it go? Did I just screw it up? Not that one. That's not the thing I want. Oh, all right. Let's go into portfolio matrix. Portfolio. Did I close it? Oh, land. I closed my portfolio matrix accidentally. Okay, here we are. Now I got to load all my data again. Anyway, we're going to come in here. So that's why you get these two numbers. Okay, so you come in here and we're going to go let's just do PLTR since Randy's doing PLTR or PLTY. All right, so he's going to do PLTY. Where's PLTY? How come PLTY didn't come up? PLTY, PLTY. It is PLTY, right? Come on. I was having problems with the speed of this thing earlier. Okay, so that's the two numbers. All right, there you go. There's the exact thing you're looking at right here. So when we go over and we place this option. Now, what they do, we're going to take it one more step. We're going to do the yield max thing. So what they do now is they sell a put right here, right there. So that's a synthetic long. They sell that. They receive $985 against their. Now, how many did we do? Oh, that's that's crazy. Look at the spread between that thing. Receive $985. They're going to pay $3,500 for a single synthetic. Oh no, that's because this is a poor man's. They're not gonna do it that. They'll probably do shorter term time frames, especially where they're now doing weeklies. So I'm doing a poor man's covered call here. You could do a sell. So you'd have to do this with the, what did we say? This is 456 days, right? So that would be, there you go. Okay, so you're going to receive 2.7, you're going to pay 35. So you're really only long on this market because you're going to receive 2,720 by selling the put at the same strike price as the one you bought. So you're going to be paying 3,500, receive 2,700. So your really outlay of your pocket on that thing is really going to be what, $500, $600, $700, $800. So this whole long position is only $800. You're going to receive $450 right now. You've almost got this whole thing paid for with one covered call. So that's the strategy that YieldMax does for you on your behalf. All right. So now think about it like this. This line right here, see this line right here? This is the options that we bought and sold, this synthetic long position. That is this blue line right here. Okay, that's this blue line right here. Now, see this covered call up here? This money, $450? That's this purple line right here. That's what you're tracking. So when you trade with PLTY, you have two lines. Now, they don't show you this breakdown in your little app that you're doing on the phone or even in Track and Trade. You go over to Track and Trade, they don't show you that. We don't show you that. The brokerage firms don't show you the breakdown of those two as a separate item. They just put them down here in your position. Now, Track and Trade does. So we try to come in here and say multi-legs, and we break them out on the chart. And you can see just we haven't placed that put option. Let's go ahead and place that thing in there for demonstration purposes. So we're going to sell that. So we're going to actually sell that. So we got to go to 25.30. Let's put that in there. 25.30. Oh, the spread on that's going to be ugly. $380. Okay, place that order. Did we get it? No, it's not filling. Oh, we're going to buy it. So maybe if we're going to buy it, no, we're not. We're selling it. So it's got to go to, that's the wrong one. Sell to open. Oh, no, that's right. Oh, 960. Was I on the wrong one? 9 point. Well, I did it on 3 separate tickets. It's okay. We got it. Okay, now you can see. So Track and Trade shows you those 3 separately. All right, and it shows you the dollar amounts, but it doesn't track them for you like Portfolio Matrix. So what we're doing now is you can see over here we've got. Now, if I'd have done this on 1 ticket, let's join them. We can do that too. We got 2. Oh, we did it wrong again anyway. We could. We did this whole thing wrong for this demonstration. They started with 1 demonstration and then ended up switching to a different idea and didn't do it right. Let's just exit chart. Okay, get out of all those. Start over, land. Okay, so we're going to demonstrate this. I think this is an important lesson to learn. See this blue line right here? This is your long calls, or this is your synthetic long. This one right here is your covered calls. Now, YieldMax is just doing this for you on your behalf, right? You give them your money, and then they go over and they say, okay, Randy just gave me $10,000. What am I going to do with it? Well, Randy wants to make money. Randy wants yield. He wants 84% yield. He wants 105% return. He wants me to send him some money every week. So I got to send him money every week. So how am I going to do that? Okay, he's going to take the $10,000 that Randy gave him, and he's going to, YieldMax guys, they're going to come over to this market. And actually, they're not going to do it on this market, but this is a good market to do it on. They're going to do it on Palantir, of course, but we're going to do it on this market, all right, because we're talking about the government-owned stuff. So now what they're going to do, they would come in here and they would buy. Let's just do it how they would do it. Let's say they're going to do the 36 days. So we're going to buy this one, and they're going to go to their puts, and they're going to sell this one. All right. Same strike price. In fact, you could look at the traditional and you're going to see them right across the side. So you're going to see 90. We got to do it right on top, just like this. Okay, both of them 90. So you're going to premium, you're going to receive 1290 and you're going to pay 1,000. So you're actually receiving more than you're paying. So this is going to be a credit spread. That's pretty cool, right? So you're going to receive $215 just for putting this on. Let's go down one. Let's go to 85. That's a 295 credit spread. That's a little bit better one. I like that one better. So we do this. We're going to do 36 days. We're going to buy this one and sell this one. So we're actually going to make money doing it. We're going to pay $295. We're going to have a synthetic long. So if the market goes up, we just make money, and they paid us to make money. That's cool, right? Sometimes it's equal and there's no cost, and then sometimes you have to pay a little bit. Usually you have to pay a little bit. This time, because of the implied volatility is so outrageously crazy, we're going to actually get paid to sell this premium. All right. So we're going to get $295. Now, remember, just this right here, if we put this on and track it for the next 30 days, that's going to be this blue line right here. Just this strategy right here is just this blue line. And you can see over the last in PLTY, the gain of doing that has been 21%. That's pretty damn good. You can say, well, I'm making 21% on my option strategy that I'd done here. Now, of course, we'd be doing it in PLTY for this chart here, but we're doing it over here in MP because we're doing the government stuff. So that is what you're tracking with the blue, this magenta line. Just your trades, all right? And of course, we're making 21%. Now, sometimes they lose money. They might trade and the market goes down, they lose money. So your PLTY doing the synthetic long might lose money down in here. But you still make money because why? They're going to come in here and they're going to sell a call against it. So now we got this one in here. All right, did we place that order yet? We haven't. So we're going to go, let's see, we're going to have to go to all the way down to 250. You always want to go in the direction that's going to lose you more money, all right? If you're like, I don't know which direction to go, it's whichever's going to cost you more money is the direction to go. And they're not letting us feel that. Maybe not. Maybe we do go in the direction where it's going to give us more money. We actually are upside down on this. I don't know. So if we're going to buy the spread now and we go to 350. I don't think that's right. Let's try it. That would be 0. Modify. Holy hell, they let us have it. I don't think that's right. Anyway, that was a 0 spread, and we're supposed to have a spread of like $150. They gave it to us for a 0 spread. All right, well, it is what it is. Okay, so now we're going to do the next leg. Okay, so now we got our magenta line in there. So that's what that is. Now we're going to go put our purple line in there. So now we're going to come in here and we're going to sell our call up in here. And we're going to do the same 36 days. And let's put it in here. That's $755 at that level. If we go way up here at 470, that's the 90%. All right, so we got 90. So what's I like to just do this with calls. And we can see the 71% chance of probability of being out of the money. And with our Fibonacci projections, even if it rallies again at that same volatility, which I don't think it will, it would still, it would probably pass our number. And then that would be our max profit. But see, our synthetic long is going to make money all the way up to there. That'd be a $3,000 income on our synthetic long. So our purple, this line here would make $3,000. And this one would make 470. So we got 470 plus 3,000. So this one plus this one. So now you're making, that's where you're getting your 84. That's where you're getting your 84% from. All right. So it goes way up there. So I don't think it's going to go up there. It's got a 71% chance that it's not going to go up there. 28% chance it's going to be above that red line. See that? Probability of being in the money, probability of being out of the money. So the probability of being in the money is 28%. So that means that this would be 28% above, right? Probability of being in the money. Well, it's 28%. It's 71% chance it's not going to happen. 28% chance that it is. There you go. So then we come in here and we sell that to open that one, and we got to sell it. So it's got to go down to the 450. 450. There we go. All right. We place the order, and that's it. All right, so there you go. So now when these things pay off and they put the money into their account, which is going to be TSLY, not TSLA, that's what your chart's going to look like, because they're tracking the income here versus the income here. This is the income of the trades. This is the income of the dividends, of the yield of the sold puts premiums. And that's the difference. And then when you add those two together, well, we did the long call here, and we made 21% over the last year, but we sold premium against it, and we made on our options selling 84%. So you add those two together and you get your 105%. Lan, what are all these numbers in here? These are your deviations. So when you do math, it's not an exact number. So when you project out into the future, it's going to be between 39% on the deviation side, and then the max range is 66. But your yield is 88 with a deviation of 39%. So it can deviate up 39% or down 39%, and your max range is 66%. So the max range, it's just, these are statistics against these numbers. So it just means they're volatile. That's what that means. All right. It means they can move as much as 46% against that 21%. It means it can have 11% above and 11% standard deviation. So it could go up 11% above 21 or 11% below. And that's just an estimate of how, based on volatility, whether that market's more volatile or less volatile. But these are the numbers. 21, 84 gives you 105% return on your money based on both of those two strategies, selling the call and putting on the synthetic long. All right. I don't know that one. It's a complicated thing. It's even hard for me to explain it sometimes. And so that's the name of the game. That's how these things work. Okay. So let's go look at the next one. So let's go look at TMC. TMC is now one we decided has not been purchased, but is in the possibility. Problem is it's only a $9 share. So the options are going to be, why bothers? We're going to come in here and look at them, and you're going to say, oh, it's all really cool and neat. We got, you just buy some options here. You're not going to do some fancy option strategy. You could do a synthetic. I mean, you could come in here and do a synthetic long. Let's wait for this thing to pull back. All right. Hopefully, it'll pull back into this region, and then this will be more likely place we want to buy. Then we just buy a long call. You don't need to do a fancy strategy. Just wait for it to come down in here. First green starts turning here, start buying some long calls. And give it some time. Don't do these little shorties. These little shorties are only when you're trying to collect premium. All right. You want to do the longers. Because how do you know how much time to buy, Land? Well, usually I do the Fibonacci projection. I take this and say from here to here, this is how long it took before it came down to here. And if it does that same ABC, well, right up in here would be your price and time. So then you're going to draw a line from here to here, and you can see that down to there, that's your price and timeline. So it'd be around mid-December. So you need to buy enough time to be out 30 days past mid-December. So how long is that? Well, it's mid-October now. So October, November, December, January, February. So we want to be out into February. So that's why I'd like to do 90 days, 3 months out. So this is 2 months out. So it gives us extra 30 days because the time decay dies at the end of 30 days much faster. So we want to buy about 3 months out if we're based on this Fibonacci projection. So there we are at 92. We look to see lots of volume, lots of open interest, plenty of players are in this thing. We don't want to buy it right now because it's flushing down. We want to buy on a red bar, but we want to, you might get your signal is going to come down like this. This is what we'll look for. We'll see it come down here, red, 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 red. It's going to give us a nice green bar, and everybody's going to freak out. Ah, it's green. I missed it. Or that's the day I need to get in. Doc Brown will buy right on that green bar. But the problem with buying on that green bar is that's generally, and sometimes it'll take off and just go. But the problem with buying on that first green bar is that implied volatility shoots through the roof, and so you pay a high premium for your option. What you want is to have that one big green bar, and then the next day it pulls back, maybe gives you a red bar, which is that pattern we always look at in the little charting pattern, right? I'm not going to pull it up in the interest of time. But it gives us that little triangle or that little pennant formation. Actually, it'd be a triangle in here. So we get a little triangle pattern. Where's our little triangle tool? Right here. So we get a little triangle in here. So we get that first green bar, and then we want it to pull back, give us that first red bar. And then when it gives that red bar, that's the buy. Because that's the little point where we want to look to get the very maximum potential of our implied volatility. All right. It's hard to sit on your hands and wait when you see the market moving. You're like, oh, I missed it. Just wait for that first red bar. And if you miss it, you miss it. I mean, sometimes you miss it. Then you go in and you pay a little extra, trying to get a little bit better price. Sometimes you miss it. It doesn't give you that second little red bar. But here it did. See, this is a perfect example right here. You got the reds coming down, gives you the greens, and you're like, oh no, I'm missing it. It's going to go without me all the way green. No, gave you the little reds, and then it's in those little reds. That's your little buy zone right there. Okay, you don't want to buy in a red market. I know nobody wants to buy in a red market, but that's when implied volatility. When you play in options, you have to be able to be willing to do that, because that's when implied volatility goes way down, and you're not going to get that volatility crush. You're not going to have a big, huge run just to make back the volatility crush. All right. So volatility will come down in the red bars and it goes up in the green bars. And if you're buying when high volatility, you're buying real expensive premiums. All right. So that's the name of the game there. So that's why we'd want to do a 90 days here. So we think this is going to come down, give us this little pattern. We'll get some greens and then some more reds. And it's in those reds that we want to buy for the next leg up. All right. Let's come and look at TMQ. Here's the next one. Government bought this one too. So Trilogy Metals. No, we said the government. Oh yeah, this is the government did buy this one. TMQ. So it's the same thing. We're going to come down here and look at the options. Let's go 64 days on this one. We got 105. Let's go 15. See what they cost. $325. Share price is $7.76. Let's just go to the long calls. It's easier to see. Spread is $10, 0.3%. That's good. Market's pulling back, $325. That's a small trade for us. That would be good. This is the first initial buyers in here. So market's back at 38.2 right now. You could put your first one in, and that way if it does take off and go some more, you're not going to miss it. If it comes down, you could add a second one or a third or a fourth. So you could come in here and we'll just buy one right now. We'll just buy right at the money. 325, that's under 375. I would rather do this one. Give us a little bit higher delta. Well, the delta's high on it anyway. We don't need to do that. We can stay at 72. Okay, so we'll put that one in. Let's just buy one right now, and then we'll buy more if it keeps dropping. This is just so we don't miss it if it takes off. Give us a little bit of fear of missing out. So we're going to buy that. So we got to go to the ask them 330, go up to 330, place our order. All right, there you go. So we're long that one. All right, there we go. That's it. That's how the game's played. So my portfolio's over here. This is what we're looking for. And as we mentioned earlier, for Randy, all the Palantir, all the yield max stuff has gone to a weekly payout. So is that good or bad? I think it's good. And we've seen examples of where the markets, when they do the monthlies, the market flushes down, and then when they went and switched it to weeklies, the market started to do better. In fact, what is the TSL? Now that's not a yield max; it's a yield boost, but you can see it in the chart. It's TSYY. If you look at TSYY, this will show you a switch. Okay, see down here, these bars down here. This is when the dividends get paid out. So you can see the colors. So the color is the distribution versus the annualized yield. Okay, so that's your colors. But that's when it was paying the dividends. So they were paying monthly dividends here at the beginning. All these were monthly dividends. And then they started doing, right midstream, they switched over to start doing weekly dividends, which is what Yield Max is going to do. And this is Yield Boost. This is Granite Shares Yield Boost on TSYY. But you can see right here, they went weekly. See all these little weeklies? So look how it stabilized the yield. The yield stopped flushing. Now, this is also the initial, the IPO, and they always overvalue them at the beginning and they flush anyway. So I'm not sure if going to a weekly had anything to do with the stabilization. I think it just had to do with the fact that they're finding their footing and figuring out where this thing's at. They're brand new. They're trying to figure out where to put their numbers, right? But this one here, this purple line is strictly from collecting premium on selling puts. There's no growth in this one. So there's no, you know how we were looking in track and trade on this one, and we were talking about, for example, we were doing this one, was this one here, where we were talking about the two lines, where this is tracking the long call, and because you got a long synthetic long, if the market rallies, you can make a lot more money. Of course, if the market falls, you can lose a lot more money. But the market's been rallying, so Yield Max been making a lot more money than Yield Boost. Yield Boost will make more money in a down market. Yield Max will make a lot more money in the up market. All right. So they're selling premium to collect premium on put options, and that's the only income they have. They have no growth. So this has no growth at all. There is no chance that it can make money on growth. The only way it makes money is on selling the premium on the puts. So you're going to see this one's had a 67% drop since they IPO'd. But again, you can't really count that. You have to wait till they get their footing. So we're going to say from this level here, but it still is going down. But their yield is so high, it's 103%. They're collecting a lot of premium on selling their options. But because of this, it really draws this down. But remember, you don't have to realize this loss ever. I mean, you can realize it after you die. Who cares, right? It's when you sell your TSYY. So if you put $50,000 into TSYY, and over the next 10 years, it pays you out 103% in yield, but you lose 67% in gain, what do you care? You're going to die. And you took your 103% payments every month, you die. And then at the end of your life, whoever's going to come in and manage your estate is going to sell that and realize the 67% loss. But what do you care? You're dead. You took the 103% profit and lived a nice life. And then they're going to come in and get the extra, 67. They're going to get 34% of the money that's in your account. And they're going to be happy anyway, because it's 37% of money they didn't have. So your kids are going to come in and say, oh, well, let's sell all dad's shares. He's losing money on them. What a shitty market that my dad got into. I'm going to sell all his shares and just take the money, and they'll take the 37% and be happy. Oh, well, we got this. And dad lived off the 103% yield. Never did have to realize the losses. Let your kids realize the losses. They're going to get the 37% and be happy anyway. What do you care? Right? So that's the total. But you get this, and then you die, and your kids get this. They get a 67% loss against the 100%. So they actually get the 35%. That's my plan as of today. I'm still a young man. I'm not going to die for another 40 years, 50 years. I'll probably live another, I don't know, probably never die. So I'll have to realize my losses at some point. But just, you can realize $3,000 a year against your taxes. So sell off enough to realize $3,000, write it off on your taxes, and then you lower your taxes by $3,000, right? But this is all taxable income, so you have to keep that in mind. Which is why you want to move as much of your money as you can into an IRA, a Roth IRA, if you qualify. This is the first year I've ever qualified because I got married and I finally qualified for a Roth IRA. So I got my Roth IRA open. But you can't pull your money out of a Roth for 5 years. So it has to be in there for 5 years before you can start pulling it out. I'm 62. I'll be 63 here pretty soon. So I won't be able to pull it out until I'm like 72, 70, 60. Well, no, 68 or something, right? 5 years. 63, 60. I opened it last year. 60, 61, 62, 3, 4, 5, 6. So I'll be 66 before I can pull any money out of my Roth. But you want to pull the money out of your IRAs, your Roth and your standard IRAs, very last. It's the last money you ever want to pull out of the market, in the way out into the future. That's the last money you want to use because it grows tax-free. And so you don't have to pay taxes on it along the way to take money out. So, but you have to pay it once you get it out. Now on the Roth, you don't have to pay it out. You have to pay it before you put it in. So you have to pay your taxes and then put it in the Roth. But you want to get it. So January 1st, I want to get as much money out of my normal UBI portfolio and put it into my Roth and into my standard IRAs. Get as much money into those tax deferred as you can, so that growth that's coming in, you don't need it. So you can let it grow tax free and you don't have to pay taxes on it. So you want to pay as few taxes as you can and they let you do that. So it's strategic. You're not cheating the government. You're doing strategically what you're supposed to be doing. That's why they do it. So move as much money into those Roths and standard IRAs as you possibly can. All right, guys, I've kind of run out of, well, we got 10 more things on my list, but I've run out of time. Keep you too long. So I want to just really quickly once more remind you that we got a book coming out, The Orion Protocol by Grant Thorne. All right. So we're really excited about this. It's just a fun little novel being printed, published by Pitt News Press. And so we're going to get this out to you pretty soon. You can buy it on Amazon probably, maybe next week. Might be able to buy it on Amazon next week. We're getting ready. We're getting the final ones coming through. So Bruce says, my kids get to realize the losses, right? My kids will be education on yield versus gain. Absolutely. Bruce is going to live off the yield and the kids live off the gain. That's how it's going to work. All right, guys. So let's come in here. We'll play with this just a little bit. I got to give you a couple little advertisements first.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, and I don't have an ad for Portfolio Matrix, but it's in what did he call it? He calls it we're in, he doesn't have it on here anymore. He's in the mode where he's asking people to come and join us while the software's in beta version, so that you can get early access to Portfolio Matrix. And then he uses you as guinea pigs to help him develop the software better. So we're all in here working with Portfolio Matrix. He's going to push a big update, he said, today, which is going to hopefully help with this loading. It goes a lot faster. And right now, it's 1 day behind. It always updates at the nighttime to tell you what your portfolio did during the day. But he's going to push that out today. I think he's going to push it out today, and it'll be live. It'll come in and you'll look at your portfolio numbers and they'll be exactly what they are in your real account. So big update coming, but go join Portfolio Matrix, and the price you'll always have the initial beta price, the low price. He won't ever update it on you. So that's the whole idea of jumping in early. Let him use you as a guinea pig, and then he rewards you by not ever raising your price. You'll be grandfathered in at this entry price. All right. But this is how we track our dividend portfolios, because the brokerage firms don't do it. They don't track them properly. So you need to have another piece of software that tracks your dividends. And this is my portfolio right here. This is you can see right here. This is real money. This is my portfolio. And you can see the green line is my income. That's how it's been growing. Each one of those yellow bars is payments I've been receiving. Payments. I got some big ones here. And then this down here is my growth. And it's been going down a little bit because I realized some of it. Right here, I realized some was I was doing my portfolio rebalancing, right? And that's my rebalance right there. So this is what my kids get to take advantage of. That red line that I'm just telling you about. That's what the kids get to have, but this is what I get right up here. All right. So my dividends so far this year, $451,000 total, 49% return on my money. So I'm up. I made $451,000 this year. That's not bad money. All right. It's not bad money. So you can come down and you can see each individual one. Look, watch, you come in here. I'll just show you a few features here real quick. Go into my UBI portfolio, UBI. So this is each line. So you can see Tesla on this particular account. Let's go to one that's got more numbers in it. There's Tesla. Okay, Tesla. I got $85,000 in Tesla. Need the headers. Current value is $81,000. So I've lost $4,000 on Tesla. So you're looking at that and you're saying, oh, Lan, you're losing money. No, that's what my kids get to recognize. They get to take the $4,000 loss. But I get the net value is 157, but my trading profit is negative 13, but I made dividends of 50,000. That's what I got to realize. Okay. So I get to realize the 50,000, and when I die, my kids get to realize they get the 81,000. So I get $50,000 a year to live off of. And if I died this year, they would close this out and take the loss of $3,000 or $4,000, and they would get the $81,000. So they get $81,000, I get $50,000 a year. Next year, I'll do the same thing. This will probably go down another $4,000. It might not. It might go up. We don't know what Tesla's going to do, right? They might make money, so might be positive and go back up. So this $81,000 is what the kids get, but I get the $50,000 every month off of that $85,000, or every year, $50,000 a year off of $85,000 in Tesla. My boys will get this when I die. I get this every year, $50,000, and I got all these. So here's another one. So $53,000, and this has gone up. So if I die, they would get $59,000. I put in 53, they get the 59, but every year I get 17. That's off of 53,000. So I get $17,000 every year off of this one. If I die, my boys will come in and they'll get 59,000. I put in 53. All right. That's how that works. That's how it works. That's why you need this special thing. And this just tells you your income right here. Come down here. Okay, there's Palantir. So Palantir, I got $12,000 in May. I got $7,000 in June. I got $5,000 in July. I got $9,000 in August. And that's just this account. I've got all these other accounts too. So we come down here to my traditional account, go in here, load that one up, come down and see the same thing. Okay, Palantir in this one, give me $2,000, give me $2,000, $4,000, $2,000, $16,000. Now this is in my IRA, so I'm just reinvesting this straight back in. I don't take it out. So that's how that works. That's how this little program works. All right, if you run it like that, that's how you want to think about it. All right, guys, Pitt News Magazine. You got to buy some Pitt News Magazine.
Hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pitt News Magazine. You can thank me later.
Pitt News Magazine.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right. We got to do it. We can't not do it. We got to show. Claire just posted a new Pitt News on Air. A new yesterday. Was it yesterday? Yeah, yesterday. She posted an article from Grant Thorne. So go listen to Claire's Pitt News on Air. All right. I think you can get it over on the YouTube channel. You can get it over on Spotify. Well, let's let her tell you about it.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast, Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday for stories, interviews, and a little behind-the-scenes scoop. We're live on Spotify, and yep, now on Apple Podcasts, too. Visit pittnews.com to follow. Come hang out with me and the gang. We're all there. Jake and Lena, of course, Land Turner, David Duty, Dr. Scott Brown, Jordan Black, and even Aiden shows up on occasion. We're having a world of fun. Don't miss out. Pitt News on Air. Because news should never be boring. It's where your trading friends are. Follow us wherever you get your podcasts.
All right, guys, go over and watch the Pitt News on Air. It's a really good one. Grant Thorne. So that's a fun one. Go watch that right now, and we'll let you guys go, and we'll see you. Oh, you know what? Next week, next Tuesday is our next class here, and it's also the first class at the university. We'll be down in St. George at the university, Utah Tech University. So come and join us at Utah Tech University. Join the class. It's for everybody. It's for kids that go to the university. It's also for adults. So go to CE, Continuing Education. I teach in the Continuing Education Department. So ce.utah.tech.edu, not gov. It's edu. So ce.utah.tech.edu. And that's where you sign up for classes. And we will see you Tuesday night live in person at the university, or Tuesday morning here on YouTube. All right, guys, we'll see you next week. Have a good weekend.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, Definitely subscribe to Pitt News Magazine. You'll thank us later.